Well, hey everybody, my name is Mike Baltos and welcome to this presentation on order flow trading made easy. And these markets nowadays are very all over the place. Today, market made a new high, and then about an hour ago we started selling off and making new lows. We're down about just over 0.5% now. And order flow is a great tool for traders to understand what's happening in the market as it's happening. It's one thing to look at a chart after the fact and say, oh, I would have bought here, I would have sold here. Yet with the order flow, it gives you that advantage that you can actually see what's developing as in the market as it's developing. So what you're going to learn today is how to easily read and understand order flow, how to turn order flow into a useful tool to make informed trades, and how to use order flow to see when the big money is getting active in the market. Now, for those that are new to one of my presentations, my name is Michael Baltos. I'm the founder and trader at Orderflows.com. But prior to that, I spent 8 years at JP Morgan. I was vice president of futures trading, and this was a trading job. It wasn't a job where I was sitting in an office looking at spreadsheets and seeing which trader was, trading too much and go over and tap them on the shoulder. No, I was there banging away at the computer. I'd come in at 6 in the morning. I was based in Singapore. So I'd come in at 6 in the morning when the electronic session would reopen, evening in the U.S. And I would be there until about 5 p.m. in the evening, which is running into mid-morning in Europe. Prior to that, I spent 4 years at Cargill. Cargill is a big commodity trading firm. Okay, I was trading desk manager there. We traded every imaginable commodity contract that you can think of, from rapeseed, palm oil, crude oil, sunflower seeds even, black sea wheat, everything. If it was tradable, we traded it. Prior to that, I spent 3 years at Commerce Bank in Chicago. I was one of only a handful of traders in the U.S. at that time, back in the 90s, that was actually licensed to trade on Eurex. We can trade the the Bunds, the Babel, the Schatz in Chicago. When Eurex went fully electronic, they started giving terminals to banks and trading firms. But then, the Chicago Board of Trade said, hey, you can't have these foreign entities coming into our ground. But fortunately, I had a license, a Eurex license that was granted by government. So I was one of only a handful of people that could trade Eurex at that time in the U.S. And prior to that, I spent a couple of years at EDF Man, which is also a big commodity trading company on a global macro trading desk. And I spent 3 years at Dean Witter. I started on the CME trading floor as a runner, literally the bottom rung of the totem, bottom rung of the industry. That's how you got started back then. Back in the 90s when we still had trading floors, it was a great time. If you wanted to get involved in the futures industry, in the trading industry, you can go down and get a job. You could literally find someone that worked on the exchange, ask them if they knew anybody who was hiring, and usually within a day you could get a job. So what I'm talking about today is what I've learned over these 25 years of actual real-time trading experience. Not just trading for myself, but trading for firms. This is what I did for a living. This is how I, paid for my car, paid for my house, paid for everything. I actually traded. It's not like I was, I was just trading on the side while I worked a full-time job. No, my job was trading, and everything that I've learned with regards to trading, with regards to order flow, is what I'm teaching you today. Okay. Now, in 2013, I left JP Morgan because I wanted to spend more time with my family, and trade for myself. I got tired of working, you know, being in the office 11 hours a day. Then you add in travel to and from the office. I was literally spending half my day outside of the house. The trade-off between family life and work life, it was work life was sucking everything out of my life, and I said I can't do this anymore. I know how to trade. I'm going to trade for myself. And eventually, I thought I should write a book. I learned a lot. I want to give back, and I'm going to give you a copy of my book. You're not going to get the actual hardcover. You're going to get a link where you can download it from. Okay, so it's a 150-page book on order flow. I talk a lot about some of the experiences that I've gone through, and how to apply order flow to the market. And you stick around to the end. Again, you'll be able to get a copy of that book. Now, since 2013, when I started trading for myself, I was using an order flow software, right? Because it's different when you work in a bank in a big trading firm because the amount of data that you have is unsurpassed, right? The banks and commodity firms, they just spend money like a drunken sailor on the latest technology. But as soon as I left the door, I'm trading for myself, I had to find the right software, right? And I looked at a lot of different software. I was even still using Bloomberg at the time, which cost over close to about $2,500 a month. And I had order flow software to help read the order flow, but it was just a basic software. And I wanted the software to do more for me, right? Because that's what software is supposed to do. It's supposed to make your life easier. Okay, so the volume footprint chart was a big step forward in reading order flow. But then there's certain things I'm always looking for in the order flow that I need to have this in the software so that it can sort of lift some of that heavy load off me. So it'll make my analysis a lot quicker and a lot faster. And I met up with a programmer who had already programmed a volume footprint chart, and I said, hey, these are a lot of the things I'm looking at in the order flow. Put them into the volume footprint chart so it will automatically appear when the conditions are met. And the program for NinjaTrader 8, I put it on NinjaTrader 8, and hence the Orderflows Trader 2.0 for NinjaTrader 8 was born. It's a volume footprint chart with 7 pre-programmed order flow indicators. And the reason I talk about that is because charts that are used in this presentation are generated from the Orderflows Trader software, which is an add-on for NinjaTrader. So before I begin, just a brief disclaimer. Trading involves risk, right? Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. So the first thing I want to talk about is how to easily read and understand the order flow. And that's why you're here, right? You want to understand, how can you add order flow to your analysis, but more importantly, how can you make it easy to read and understand, right? On the trading floor, locals paid thousands of dollars a month in leases or hundreds of thousands of dollars for a seat. And why? So they can see the order flow. Why? So they can follow the money. You always hear that term, follow the money. When a trader is on the floor in the old days, when there was open outcry, they'd always be watching what the big brokers are doing because they would understand who their customers were, or what the Goldman desk was doing, or what the Cargill desk was doing, or what Solomon desk was doing because Solomon's customer may have been George Soros or somebody else, or a big company. They would always be watching what those brokers are doing. What are they? How are they active in the market? But when the floors dried up, when everything went electronic, they didn't have that edge anymore. A lot of these guys that were locals on the floor now are, they're out of work. That was their skill set. Unfortunately, kind of sad, but they're out. They they can't read what's going on in the market because they can't see that flow. Now, that's where order flow comes in electronically, right? Because you can take the data that's coming out from the exchange and you can format it in such a way so you can see, the activity of the big traders that's going on. Now, while we can't see who is buying or who is selling, like on the floor, right? You can see Solomon Brothers is selling or Goldman Sachs is buying, right? You don't have that transparency electronically. You just see 600 contracts traded at this price, 300 traded at this price, right? And the other thing is you don't know if they're getting long or they're getting short. Right? You sort of have to put it in context with what's going on in the market. But what we must focus on is the things that we can see. We can see the big orders that are being traded in the market. When an order hits the market and it trades on the exchange, it gets posted, right? You're going to see that data come through on your computer. Now, if you're looking at a normal candlestick chart, right? You just hear your regular everyday candlestick chart. Some people think it's the greatest chart ever because, I can see the open, I can see the high, the low, the close. I can see the relationship between the open and the close. And, I can make a decision from there. Well, that's all well and good, maybe 100 years ago, but why limit yourself? Okay, the volume footprint chart, yeah, it shows you the open, high, low, close, but you can see the volume that's traded on the bid, the volume traded on the offer. You can see where there's a buying imbalance, where there's selling imbalance. You can see where traders are defending a price. You can see where traders are being more aggressive. You can see where price is being exhausted, and so much more that you're not going to see on just a normal candlestick chart. Now, most traders, when they hear the term order flow, they think of the dome, right? The depth of market, price ladder. And the difference between the dome and a volume footprint chart is the dome just shows you the working orders. Okay? It shows you what's on the bid, what's below the bid, the next bid below that, what's on the offer, the next offer, the next offer. The footprint chart records what's traded in the dome, and it'll put it on a chart. Okay, so you can see, how much traded on the bid at 33.39 and a quarter, how much traded on the offer at 39.39 and a half, or what traded at 39.39 and a quarter versus 39.39 even. Now, if you look at a normal candlestick chart, you don't even see the volume, right? You're just looking at where the low is, where the open is, the high, and the close. Now, order flow is really about understanding what the aggressive traders are doing in the market. Now, if you don't understand what aggressive traders are, think of it this way. In the market, there are passive traders and there are aggressive traders. Passive traders are people that are either trying to buy on the bid or sell on the offer. They're waiting for price to come to them. But for a trade to happen, someone has to get aggressive. Let's say the market is 33.39 in the bid and 33.39 quarter offer. 78 on the bid, 98 on the offer. For a trade to happen, either one of the passive buyers there at 39.39 has to be aggressive and buy one from the seller at 39 and a quarter. Or for a trade to happen as well, either someone that's trying to sell it at 39 and a quarter has got to say, you know what, I think this market's going to go lower, I don't want to miss it. They got to lower their bid to 39.39. They're going to be aggressive. So just remember, aggressive sellers sell to passive buyers, and aggressive buyers buy from passive sellers. The way to think of it is, you want to buy a car, okay? You want to buy the new Corvette, and you go to the dealer, you see he's got one there for $65,000, and you think, I don't want to pay $65,000, I'll bid $60,000. Well, he wants to sell it at $65,000. So you guys, no trade's going to happen unless one of you is going to get aggressive. The dealer may think, oh gosh, I got a truckload of these Corvettes coming in next week. Fine, I'll sell it to you at 60,000. And he got aggressive, he sold it. Now, if you're going to be the aggressive buyer, think, gosh, I really want this car because I got a hot date later this week and I want to impress the girl. So you're going to go buy it. You're going to take 65,000. Okay, you become the aggressive buyer. So remember, aggressive buyers buy from passive sellers. Aggressive sellers sell to passive buyers. Now, candlesticks charts, right, they leave out a lot of information. The footprint chart has that information, but if you like your candlesticks, you can keep them because you can have on your chart still your candlestick. But you can see, the candlestick chart has, the volume, what's traded on the bid, what's traded on the offer, where the market's showing aggressive buying, where there's market exhaustion, the net difference between the aggressive buyers and the aggressive sellers. And, it's from that information that you can start analyzing, is the aggressive buying getting weaker or is it getting stronger? Is the aggressive selling getting weaker or is it getting stronger? Now, earlier I just explained, that volume footprint charts allow you to see the volume traded on the bid, the volume traded on the offer. And once you have that information, a trader can then take the data and see the delta, the point of control, and the imbalances, and and find some good trading opportunities. So first I'll talk about what is delta. Okay, so delta is the difference between aggressive buyers and aggressive sellers in a bar. And if you're looking at a normal candlestick chart, you can't see where traders are being aggressive. You can't see, is there aggressive buying or aggressive selling? You don't know what's going on in the aggressive in the trading. But on a volume footprint chart, you can see where aggressive traders are in control by watching the delta. Now the delta is going to be along the bottom, and what it tells you, right, if it's positive delta, it tells you aggressive buyers are in control. If it's negative, it's going to tell you that aggressive sellers are in control in that bar. So if you see a bar, like here at 1234, it's got a delta of -8. It tells you, aggressive sellers were in control of that bar, but it was kind of weak because it was only a difference of 8. It was -8, so it's got a negative delta. Whereas the next bar, you can see the delta is 75. So it tells you it's a positive delta. It's green, right? It's red, it's negative. So it tells you aggressive buyers are in control. So what happened? It went from aggressive sellers in control to aggressive buyers in control. And then the market keeps going up in the next bar, positive delta, 379. So an even stronger positive delta. So now you know aggressive buyers are firmly in control, and you can see the market just drifting, going higher, 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 all on positive delta. Now, point of control is the price level in the bar with the most volume. Now, on a normal bar chart, you can't see point of control. All you can see is the open, high, low, close, and the relation of the open, high, low, close. But on a volume footprint chart, you're going to see the point of control with the most volume, right? And why is that important? It's because, volume represents, or how to phrase it, represents an area where traders are happy to transact. It represents value. And you can see here in this purple box, I put this box around here because you can see you got 1, 2, 3, 4, 5 bars with more or less the point of controls right around the same level, right? So it's indicating to you that value is being formed, right? And when you have value being formed over time, what is that? That's either support or resistance. In this case, it's support because it's coming in near the low of this move, right? And people are happy to trade here. Buyers are happy to buy. They're happy to accumulate a position. Sellers, are happy to sell, but it's the buyers that are in control right now. Why? Because you can see by the positive delta, even when there are negative deltas, they're still quite small, -31, -8. Right? Then you can see the buyers finally take control of the market. After they're done absorbing, they start getting aggressive, and the market starts moving up. Now, imbalances. Now, this is the third part of sort of the building blocks of order flow. They occur when you have more aggressive buyers than aggressive sellers in the two-way auction. Now, most of the time, the market is balanced, right? It's when the market starts going out of balance that trading opportunities arise. So remember what I told you, right? Aggressive sellers sell to passive buyers, and aggressive buyers buy from passive sellers. But when you have aggressive buyers outnumbering the aggressive sellers in the two-way auction by a ratio of 4 to 1, that's considered a buying imbalance, or vice versa, selling imbalance if you have more aggressive sellers than aggressive buyers in the two-way auction. Remember, right? Markets move in a two-way auction. So when you look at the volume footprint chart at 39.39 even, offered at 39.39 and a quarter, and you see, there was 220 traded at 39 versus just 20 traded at 39 and a quarter, then aggressive sellers are imbalanced. Right? You have more, in that case, you have 10 times as more aggressive sellers than aggressive buyers. And on a normal, regular candlestick chart, again, you can't see where these imbalances are occurring. On a footprint chart, you can see, okay, got aggressive buying coming in here, right? As the market starts creeping higher, all these bars going up, got the aggressive buyers occurring. You can't see that. This is the same time period on a candlestick chart. So if you're looking at a footprint chart, you can see where the aggressive buyers are coming in. And so once you understand the importance of delta, point of control, and imbalances, you can apply them to the market as it's trading to make good trading decisions. And what that means is, as the market is trading, as it's unfolding, you're able to make instant decisions based on what you're reading in the market. Now, this is yesterday in the evening. Okay, so if you remember, right after 2 o'clock, we hit our high. Okay, so we're at our high. Anytime you're at a high or low, you always got to be asking, what's the market going to do next? Is it going to keep going higher,
or is it going to turn around and sell off? Just as we are at a low, are we going to make new lows, or are we going to bounce? Or are we going to go higher? So here we're at the high of the day yesterday at 57 and a quarter. We got a nice strong positive delta of 660. Okay. Okay. Well, maybe we'll go higher, right? Because we got positive delta closing right up near our high. But then if you watch the next bar comes in. It's a red candle. Okay. Got negative delta. That's not a good sign. You're at your high of the day. Sellers are all of a sudden in control of the market. What else do you have? You've got 1, 2, 3 imbalances appearing in the bar. Again, it's also very bearish, right? The point of control coming in lower than the previous bar. So remember, if you remember, I just said points of control act as value in a bar, right? The most traded price is the fair price for that bar. So if all of a sudden the next bar is lower, people are pricing the market lower right now. Okay, so the next bar comes in, kind of mixed. You got negative delta, which is obviously bearish. Point of control, is one tick higher, and you still have one selling imbalance in there. The bars are doji, it opened and closed at the same price, so it's kind of neutral. Then the next bar again comes in negative delta, got a lower point of control. Now this point of control is the same as it was 2 bars ago, so we're sort of putting in value here, but the bars got an imbalance in it, and it's got negative delta. So sellers are slightly in control now. So we're just right up off our high. We got 2 bars out of 3 that are very negative, and then another bar comes in. Right, we got a higher point of control, but again, it's only 1 tick higher. So now you got 4 bars. You take those 4 points of control in the bars here. You can sort of average them together to get one price. You got negative delta minus 284. Obviously, you got a selling imbalance. Bar goes lower. Right? It's not a good sign of a market that's looking to pop around, turn around, and go higher. It's starting to shape up as a market that's getting ready to sell off. Boom. Next bar, big strong negative delta minus 1300. You got a lower point of control. You got just one imbalance, but you can see how the market is telling you from 2 bars ago, 3 bars ago, that this high is probably going to hold for now. And then the next bar, just an inside bar, still got negative delta. Point of control is neutral because it's the same price. You don't have any imbalances. Kind of a mixed bar. Then the next bar, again, it's another inside bar. You still have negative delta. Point of control, same level. You do have one selling imbalance. So, at this point, you got to be asking, is this market getting ready to go back up, or is it getting ready to fall over? And there's nothing in here that's remotely bullish. Right? Then you get another bar. It's not an inside bar, it just breaks it by 1 tick to the upside. Point of control 1 tick higher. Okay. You got a small delta though, it's only 13, right? Which isn't, for the market to move higher, you're going to need strong positive deltas, not a delta of 13. And you need like 300, 400 positive deltas, meaning aggressive buyers are in control. And there's a selling imbalance in there. Then next bar continues on down, right, as expected, right? Negative delta, lower point of control. Point of control is coming in lower than these previous 4 bars, where it's all sort of aligned nicely, right? You got 1, 2, 3 at the same level, 1 higher, and then boom, coming in lower. So now what's happening, right? We're rejecting this price at 54 and a quarter, and we're putting in a new value area lower. So you can see how the value areas are moving lower. Earlier, right off the high, you had 4 point of controls, which more or less, you could average those prices to get one level. Here you got 3 at the same level, 1 a bar higher. So you have a value here, and then you put in a lower value. Now you start to put in a lower value. And again, you got the big strong negative delta of minus 500. The next bar puts in another point of control at the same level. It's got a small negative delta, and it's got a buying imbalance. And it's still, it's one of those bars that as a trader you kind of hate seeing because it sort of muddies up the picture a little bit. And you're short already, and you sort of get this green bar, and sometimes traders like to panic and they'll cover their shorts now when they really shouldn't. Okay, then the next bar, strong negative delta. You got a lower point of control. Got one buying imbalance, but I wouldn't worry about that. It's just 4 against 57. It's not like 4 against 500. Then the next bar, lower point of control, negative delta still. We got selling imbalance, so we're continuing our move down. And then that next bar, which everything changes, you push lower about 2 points lower. Then it reverses and goes up near the high. You got a couple of selling imbalances in there. You got a big negative delta, but this bar, you know, some of my advanced lectures that I've done on most stuff on YouTube, I talk about this type of bar on how this is a reversal bar in the sense that why you got negative delta and a green bar is because you have supportive buying coming in here. So this is the sign to finally get out of this trade that you've been short from the 56 area down into the 3 area. This is the regular candlestick chart, right? To me, looking at a candlestick chart, it's not obvious at all. Right? You can make arguments for selling up here at the high. Oh, you got these big red candles, etc. Candlestick guys, when they're right, they wave their arms around the trader. When they're wrong, they're all quiet. Okay, so there's a lot of bearish candles on this way up here. Okay, so don't feel shame if you look at a candlestick chart and sometimes you can't figure out what's going on. But when you look at an order flow chart, it really starts to fall into place. So you can see by watching delta, point of control, and imbalances, you can understand what's going on in the market right now on a bar by bar basis. But wouldn't it be better, right, if you had software that would highlight that to you in real time, order flow nuances that you could trade around? It's going to make order flow trading a lot easier. And that was my whole point of creating my software years ago. In fact, I created my software for my own use. Actually, I didn't create it to become into a software vendor. I was trading for myself, and I was sharing it with other traders, and they're like, "Hey, you know what? You don't realize what you got here is help a lot of people." So, that's why eventually I started up the orderflows.com. So what I want to talk about now is points of control. Okay, I'm going to go a little bit deeper into some of these topics. So I'll talk about points of control. Every bar has a point of control. However, depending on market structure and volume involved, a point of control can show you market-generated support or resistance as it happens. Okay, so for example, again, in yesterday, right? Everything I'm showing you is from yesterday. On a regular candlestick chart, what can you see? We can see, oh yeah, the high was made, it came off, and hit another, looked like it was coming back up and sold off. Okay, but rather you should be asking, what you don't see. What a lot of traders will do is they'll look at after the fact and they'll see the high poking up here at 53.5, 53.75. Oh, well, that was resistance. They'll just make that statement, right, without anything to back it up. But actually, I'm going to show you where the resistance came in the order flow that was very clear. Okay, so this is the footprint chart. And again, I ask you, can you see the resistance? Some advanced order flow traders will see it right away, but for others, it's not easy to see. But there it is, right, where the arrow is, this purple box. Right? This was one of the things that I wanted in my software. Tongue tied. I specifically told my programmer, I want to see these, what I call prominent point of controls, these point of controls that matter in the market that are going to act as support or resistance, and we're going to highlight them in a different color. But again, if you're just looking at a normal footprint chart, you're not going to see it. If you're looking at a normal bar chart, candlestick chart, you're not going to see it. But it's coming in right in here, in this purple box. Put a cap on the market for moving higher. And you can see how, over the next 5 minutes, it makes a nice methodical move down. Okay, so I'm going to show you a bunch of different charts. Now, I'm going to show you different charts. Don't think you have to have all these different charts open. The reason I'm showing you different charts is because, everybody trades differently. Right? We all don't look at a 1-minute chart. We all don't look at a 5,000 volume chart or a 4 range chart. So, however what type of chart you're looking at, the same things apply in the order flow, whether you're looking at a 5,000 volume chart, a 5-minute chart, a 30-second chart, whatever. You're going to still look for the same thing. So you can see here's the prominent point of control. At the swing low, where does it rally up to? Another prominent point of control where the market hits the resistance area and just goes sideways. Here's a 1,000-tick chart in the E-mini. You see the two prominent point of controls there, putting a cap on the market from moving higher. Here's an 8-range chart. You can see that's the double top. You can see that's the prominent point of controls acting as resistance on the move down. Right, for the market to move down, it just doesn't always happen on aggressive selling. People selling the market lower, lower, lower. The big traders are going to be offering it out, and they're going to be putting a cap on the market, just as on a move up. The big traders are going to be offering support in the market. They're going to be help you bid the market up. Right? And what you want to do is, once you recognize that, you're going to trade in that direction. So that's why I talk about, going with what the big traders are doing. So every time, you pop up to a resistance level, you want to get short if you're not already short. Here's gold, right? It's a 1-minute chart yesterday. Boom, right off that low at 27.80. Yeah, at 20.28. Big prominent point of control just sticking out right there. And over the next 10 minutes, market put in a $5 rally. Here's bonds, right? 4-range chart. You can see we're putting in these nice prominent point of controls here as support for the market. Market rallies up to resistance area. Market comes off. Where's it come off to? Now, when you came off, you didn't see the prominent point of controls, but we're coming off right through those same levels. Those were your support earlier. You came off, you rallied up, and you start coming off. Where do you come off to? You're going to stop at support. Crude oil, right? You can see, right? Just off the high of the day, you got resistance selling coming in. Market comes off, rallies up a little bit, comes back off, price rally again, boom. You got another resistant selling, another prominent point of control in the market. As the market sells off to where? Down here we got two prominent point of controls acting as support. And this is happening in the market in real time. You can see this happening in real time and trade it. You're not saying, oh yeah, there's resistance up here at 42.30, and by the time you're trading it, you're already trading 42.10. No, you can see that instantly. As it's happening. Oh, hey, there's resistance at 42.30. I'm going to try and sell 25. So market comes back up to 25.26. You're short. Boom. Market sells off down below $42. Where you hit these support areas down here at 41.88. Down here, prominent point of control, prominent point of control. Market comes up. Okay, yeah, I've got my bids in here around 41.90. Boom, you get filled. Market rallies back up to above 42 plus. So as you can see, some point of controls are more important than others, and having software that shows you point of controls that matter will put you ahead of other traders who can't differentiate one point of control from another, and so put you ahead of those traders who are not even looking at point of control at all. Now, what I want to talk about is imbalances, okay? And a buying imbalance, like I said earlier, occurs when in the two-way auction when there are more aggressive buyers than aggressive sellers by a certain ratio, usually 4-to-1. A selling imbalance is the opposite. It's still a two-way auction, but when you have more aggressive sellers than aggressive buyers by a certain ratio, again, usually 4-to-1. Now, this 4-to-1 is not set in stone. Some people use 3-to-1. Some people use 10-to-1. You could adjust it anywhere. I know some people that use 6-to-1. I use 4-to-1, and in some cases I use 3-to-1, but generally I use 4-to-1. So how does the trader use imbalances to their advantage? Well, the first place to look is in a bar. Right? Is the candle moving up, green candle, and are there buying imbalances? If so, how many? Candle moving down, is a red candle, and are there selling imbalances? If so, how many? So again, yesterday's high in the S&P. Right after we hit that high, you can see that bar had 3 selling imbalances. Right? That's not a good sign for a market that wants to go higher. Right? What do you see? So, if you're looking at the Oracle chart, you see aggressive sellers clearly in control of that bar. Right? Now, this is crude oil, right? You can see as the market moves lower, what do you see? You see the aggressive sellers, right? So as the markets move up, you see aggressive buyers, right, in the form of buying imbalances. And as the markets move down, you see aggressive sellers in the form of selling imbalances, right? Here's the market moving up, and you see all of these little buying imbalances early, right before the big move up just started. Now, most order flow traders understand what imbalances are and why they occur. The next step is to apply them to the market. Now, stacked imbalances is how most traders apply imbalances. And what a stacked imbalance is it's a bar that has three or more either buying imbalances for a stacked buying imbalance or three or more selling imbalances for a stacked selling imbalance. Then stack neatly on top of each other at each price level over three consecutive price levels. So like you see the stack buying imbalance down here at 31, at 31 and a quarter, there's another one, and 31 and a half, there's another buying imbalance. It says on the selling imbalance, you got one at 33.33, 32 and a three quarters, and 32 and a half. Right? They're all neatly stacked on top of each other, and that's all. That's nice. It's pretty looking on a chart. You can draw zones out and try to play the pullbacks into them for good entry to get short or get long for a buying imbalance. Optically they're pretty, okay, but sometimes by the time that you see them, the market is already put in a big move because sometimes when they appear, it's a bit of FOMO, right? Traders have missed the move and they're sort of rushing into the market. And like I tell a lot of people in my weekly classes, there are two problems with dealing with imbalances. If you just wait for stacked imbalances to occur and trade them, sometimes you'll be waiting for a long time, and you're going to miss a lot of great trading opportunities in the meantime. And some bars have imbalances, some bars don't. The bars that have imbalances, which imbalances matter? Again, some bars that have no imbalances. Okay, some bars may have one, some bars may have two, some bars may have three or more. What bar do you think has the potential to move the most? A bar with one imbalance, two imbalances, no imbalances, or a bar with three or more imbalances? Well, obviously, the answer is a bar with three or more imbalances, but not necessarily stacked, right? I said, a lot of traders spend a lot of time looking for that stacked imbalance that never comes. So bars with three or more imbalances, okay? So you can see a nice stacked imbalance here as you're breaking through this low of the day here. This red line is the low, 33.35. Yeah, nice stacked selling imbalance here. See, that's great. The market continued to move all the way down to 29 before reversing and rallying back up. But look at the bar, two bars earlier. It's got four selling imbalance. Okay, and that's coming in 2 points higher than the stacked selling imbalance. Would you rather have 2 extra points in your move? Then on the way back up, do you see any stacked buying imbalances? No, there is none. But you see one bar with 3 imbalances, another bar with 3 imbalances, another bar with 4 imbalances. Right? Do you think this information is useful to you? Of course it is. The Orderflows Trader software will put a box around the bars with multiple selling imbalances, 3 or more imbalances, either selling imbalances in the down bars or buying imbalances in the red bars. Right? That's why I talk about letting the software do the work for you. And again, if you're not using software that's going to highlight this to you, you may not see that right away. By the time you see it, you may have missed the opportunity. Right? And trading is an opportunistic endeavor. Right? You got to take advantage of this stuff as soon as it happens. Right? That's where your edge is going to come in, is by getting in on trades that other people are just completely missing for whatever reason. Okay, so again, here, look for the imbalances. Okay, so I just talked about these prominent points of control and how important they were. But did you know that these bars also have multiple selling imbalances in there? Okay, so it's telling you, there's resistance in the market with prominent points of control, and there's aggressive selling. So two bearish points. Honestly, we live in a great time for traders. Computers are affordable, easy to open a trading account. Markets trade around the clock, so it doesn't matter if you're working during the day, you come home at night, you can trade E-minis. And now they have micro contracts that you can trade that have very low margins. You know, back in the just 20 years ago, to open a trading account, to get a low commission rate, low was considered, $10 a side. Even before that, back in the 90s, $20 a side, which is $40 a round turn, was considered discount already. And now we're living in places where they have day trade margins. So literally, there's brokers out there. Again, I'm not pimping any brokers, but there are brokers out there that you can trade. You can open a futures account with $300, $400 and trade the micro contract with $50 margins. It's a great way to get started. You don't have to go all in and trade full margin. If you go opening a small account with a few $100, just trade one micro. You don't need to, you got $50 margin. You don't need to trade, 10 contracts on a 500. Just trade one. Get used to the market. It's a great opportunity to get started at low cost. Like I said, it's a great time for traders. Now here's gold, right? Can you see what's happening in the market, right? Yeah, you can see the stacked buying imbalances as the market is going up. Okay, that's great. Then it hits this point here at 29, and then it just falls off from 29 down to 25. Okay, but if you're using software that's going to highlight things to you, right? You see, put the arrows here where the multiple buying imbalances are, the multiple selling imbalances are. Even up here, the prominent point of control. Let the software highlight all that information to you. Boom. See, it's got the pink box around it. It's got the prominent point of control, the bearish prominent point of control up here, followed by a bar with multiple selling imbalances. And again, you could be getting short in here at 28, well before it breaks down here at 26. Most traders are going to see this move. They're not going to know right away to get short unless they're looking at the order flow. Obviously, you can see the delta is all negative up here. This is last night at just after 10 o'clock. Okay, so this shows you, like I was saying, it's a great time for traders because there's liquidity around the clock. You can trade a lot of these markets in the evening time, even if you're working. And again, you don't have to be going all in and trading at full margin. You open an account, throw $3,000, and just trade one lot. Simple. On a normal bar chart, right? You're not going to necessarily see that. You'll know but on the footprint chart, you're going to know there's resistance, and you're going to know there's selling imbalances by watching the order flow, right? Some candlestick guys say, well, you got that type of candlestick here. Well, you had a similar one there. Then you had a lot of bullish candlesticks on the way up. That's neither here nor there. That's an argument that is often had after the fact, But as a trader, right, you want to be alerted. Okay, yeah, I got resistance up here based on the order flow. I got aggressive selling based on the imbalances in the order flow. I've got negative delta that's telling me sellers are in control. We just made a high, but there's negative delta, right? Do you think the market's going to go any higher? No, it's not. You're going to need aggressive buying for the market to go higher. Instead, you're seeing the opposite. You're seeing resistance selling, you're seeing aggressive selling, and you're seeing each bar being in control by sellers. Right? That's not a recipe for a market to go higher. That's a recipe for the market to go lower. All right, so hopefully by now you can understand. Order flow is a great tool for traders to understand what's happening in the market. And honestly, there's so much more to cover. For example, I didn't even talk about these little red arrows on top of bars, these little green arrows. These are bullish and bearish instances in the order flow to either get you into trade, or if you're in a trade, keep you in the winning trades longer. That's where real benefit is for many traders, is being able to manage a trade. And that's something that goes sort of hand in hand. Everybody says you got to cut your losses short and let your winners run, but they don't actually tell you how to do it. When you read the order flow, you can see whether the order flow that's happening after you're in a trade is bullish or bearish. So if you're bullish and all of a sudden you see a bunch of bearish order flow, that's not a good sign, right? So you got two choices. One, you could let the market just go and stop you out, or two, you could pull the plug on the trade, get out early. Now, if you're long and you have bullish order flow following after you get into the trade, That's good. You can let the trade run longer. Right? That's how you let your winners run and cut your losers short, by managing the trade. You don't let your winners run and cut your losers short by throwing in an arbitrary stop and take profit based on an average over 20 trades. No, you watch it by what's happening in the market. It's for a trade to become profitable, you need the order flow that follows once you get into that trade to go in your direction. If it's not going in your direction, trade is going to struggle to turn a profit. Now, I covered these topics such as, what all these little green and red arrows mean. It's generated from my software, and numbers above and below the bars, for in my weekly group training session for users, which I'll tell you about more of that in a minute. But hopefully by now, you should start putting together the different parts of order flow, and you can see the market makes sense. Order flow analysis provides the trader advanced information they need to gain an edge over other traders. So that's all I said. You got to have an edge in the market. And then they don't tell you how to get an edge. Order flow gives you an edge, allows you to see and understand what's happening in the market that other traders just don't see. So hopefully you can see how powerful order flow analysis. Remember, don't overcomplicate trading. People like to overcomplicate trading for some reason. I got to throw 10 indicators up on my chart. I got to throw 5. Or they'll say, what's your best indicator? Read what's happening in the market right in front of you. So if you found this helpful, you're going to like my Orderflows Trader 2.0 software package, which makes the analysis easy. And there's 2 ways you can go about becoming a successful trader with Orderflow. One, you can try and learn Orderflow on your own. It's going to take you years by looking at a screen and trying to figure out Orderflow. I spent 25 years trading. Okay, it's not something that comes instantly. For some people, it does. People are autistic, or can pick things up really quick. And more importantly, you don't want to waste years and money trying to learn it, right? Second way is get the education and software from a trader who's successfully traded order flow at the highest level for decades. Skip the massive trading losses, skip the wasted time, sort of go to the front of the line. Remember, order flow is the most current information available to a trader. And it's not some indicator, it's the market, right? Order flow is not based on pivot levels, it's not Fibonacci, it's not based on Elliott waves, it's not based on MACD, etc. It's not based on VWAP. Order flow is what's trading on the bid and what's trading on the offer. Basically, it is the market. You're trading the market, right? You're not trading the indicator, you're trading the market. So the Order Flows Trader 2.0, I was telling you about earlier, it runs on NinjaTrader 8. It'll run on the free version of NinjaTrader 8. So if you're using a broker's trading platform, you can download the free version of NinjaTrader 8 and load up my software on it, and it'll run there. Obviously you're going to need to pay for a data fee. And what it is, it's a volume footprint chart with 7 pre-programmed order flow indicators. I'm also going to get my chart template, so your chart could look just like mine. You don't spend hours trying to figure it out. Normally I sell it for $899, but I realize, having order flow software is one thing. The next thing is to know how to use it. So I don't just give you the software and send you on your way. Try and figure it out. No, I provide a lot of education on how to trade with order flow. Now each week, Tuesday, so I have one tonight, I do a private live group training session just for users. If you can't attend, you can watch recordings. There's over 80 recordings now. Some gurus, like to charge extra for this. I give it to you for free. Why charge you extra for training on how to use the software, how to read the market? That should be free. And it's ongoing. I got guys that bought my software 5 years ago that still attend these sessions. They still love. Sometimes I'm late in sending out the invite for the training session, and these guys will hit me up. Hey, I having a session tonight. It's amazing. The best traders are the traders that want to learn. I also give you access to my Order Flows trading course, which I normally sell for $297. You get access to that for free, as well as my Inner Circle video series. Normally I sell this for $497, and what it is a collection of 56 advanced videos on advanced order flow tricks, but nuances, tips, and analysis. You can get it for free. Each video is about an hour long. So, $899 for the software, $297 for the order flow trading course. the inner circles know they're $4.97. The weekly group training, I don't know, put a price on it. Again, some people have been attending that for years. That I can't even put a price on. Think of it like this, right? You've ever been to Disneyland or amusement park? And, you get out of your car, you walk, oh my gosh, look at that line. What I want to do is take you to the front of the line. All these other traders trying to learn how to trade that don't want to, fast track it. Because what I want to also give you is access to my order flow playbook, which is normally $297, and we'll give that to you also for free. So you're pushing close to $2,000, right? Possibly more with the live group training. But again, if you're unsure, it's what other people are saying. Mike, your order flow software is remarkably helpful. I can clearly see now what's happening in the market. Like, for example, who's in control of the market on a very specific time and who's getting well. Other traders say you give a really fresh and clean air in the field, very impressive, very rare. Mike's experience and explanation makes it click. So, if you're interested, go to orderflows.com/off2 because we all want to be successful. But to become successful, whether it's in trading or any other line of work, you got to plan it. And you got to figure out how you're going to get from point A to point B. So for a one-time payment, of just $675, you're going to be able to get the Orderflows Trader 2.0. So go to orderflows.com/off2.html. There's no other monthly payment. It's not going to hit you up and say, oh, I got, you got to pay this fee, every year or something. No, it's just a one-time payment. It's not a yearly fee. That's it. It's just $675. So what you're going to do after you go to orderflows.com/off2.html, take you to this page. Just scroll down to the bottom of the page. Okay. So you'll see the button says buy now. I want this. Right? You want to get started. Take you to PayPal. I don't process your card. I don't want any of your information, anything like that. PayPal is a third-party processor. Everybody's familiar with PayPal, I think. But again, if you don't have a PayPal account, just say pay with debit card or credit card here, and it'll take you still within PayPal. Now, if you want my book, the Orderflows book, Trading Order Flow, go to orderflows.com/book.html. You'll need to enter your name and email address. After you do that, hit submit. Okay, then they'll take you directly to the download page of the PDF, so you can save it to your computer, you can save it to your smartphone, you can save it to your tablet, print it out, read it over the weekend. It's a nice book, and this is my way of giving back to the trading community. But again, you got to get started sooner or later, right? So you got to act now. Go to orderflows.com/off2.html. It's strange because there's people that I've communicated with that have, over the last couple of years keep telling me, I want to start trading, and they never get started. I'm just like, you got to get started sometime. It's something to want to do something as opposed to doing it, right? You got to take action. I remember I used to work with this guy, just a perfect example, and they kept telling me, oh, this girl I want to ask out, girl, I want to ask her out. And it's going on like that for a week. I'm like, dude, just finally do something, ask her out. And he did. And, a year later, they got married. And I'm like, man, you spent all that time, oh, she's not going to be interested in me. You don't know unless you start doing it. You don't know if you're going to be good at trading unless you start trading. And I just want to have a caveat. Trading is not for everybody. I don't want you to have them coming in here with high hopes thinking that, oh, this is, the holy grail of trading. No, trading takes work. And you got to want to be able to put in the work and get going. So, it's not an easy journey. So, you're going to want to get started sooner or later. So, I'm just going to take a look at see if there's any questions here real quick. There's not really any questions, but one of the questions that I get is, it doesn't work on stocks and doesn't work on forex. Well, the thing with forex, right, is that the exchanges are not centralized, right? Like on CME and CBOT, right, where the E-mini and bond trade, those are exchanges, proper exchanges, and every trade that goes through is registered, and everyone in the world can see that they traded. Now on forex, right, you got what you have, a lot of brokers, and what they have is white label products from banks, and basically it's the bank giving you basically giving you their best bid and offer. So the data you're going to see on your screen is different from what you're going to see being traded. So it does work on forex, but you can trade on the CME forex contract, the euro currency, Japanese yen, British pound, and really quick on stocks. Yeah, your best trading most liquid stocks, obviously, the FANG stocks, Apple, Google, Netflix, Facebook. So they trade a lot of volume, and remember, you're analyzing volume. Now, one other question: what time frame do you trade typically using your software? Well, order flow is based on what's happening right now. So if you're trading a 30-minute chart, but you're reading order flow from 30 minutes ago, an hour ago, it's not going to be any useful to you. Honestly, it's best to trade order flow on shorter time frames, 1 minute chart, even range-based charts, because you're watching how the market moves from price to price. Um, you know, me personally, I don't go over 5 minutes. I use 1 minute chart, I use 30-second charts, and in some cases, I do go a little bit shorter. When I trade NASDAQ, I will go down and actually do a 50-second chart. No, I don't have a trade room anymore. It's just not possible for me time-wise to do. And it's one thing to have a trade room and explain trades. There's another thing to actually be trading. And it's just I just don't do it anymore. I used to do it a few years ago. I don't do it anymore. I've got 3 kids now, and with the stay-at-home order, and it looks like the school year is we're going to be staying at home again. Um, it's just not possible to have a trade room. It's hard enough for me to get in the time daily to trade with the kids running around. That having a trade room is not. But I have the weekly group training session, so I talk about things that I've seen in the order flow, over the last week or so, anything interesting. And another question? Is this a standalone way of trading? Nothing else is required. Well, again, order flow is a tool. Okay? It's about reading what's happening in the market. I know some people that added order flow because they already have a way of trading. They have their own way of drawing order resistance in the market, or areas where they think the market's going to react, and they want to know what's happening in the order flow. So can you use a standalone? Yeah, I use a standalone, but again, there's other people that have incorporated into their own method of trading. So anyway, on that note, I kept you guys here for about an hour, and I appreciate your time. I know we're all busy these days, especially those that have kids in the house and trying to juggle everything. It's a big thing to ask. So I'll end it there. If you got any questions, you can just email me, mike@orderflows.com. Or, I suggest, get started, read the book, download the book. It's orderflows.com/book.html. Where is it here? That's a great way to get started. Go to my YouTube page. Okay, I've got a lot of videos on there. I got over 250 videos. It's also a great resource to get started. If you want to know more about order flow and, is it something that suits you? Okay. And again, the best thing to do is just get started. So, anyway, Kathy, I'll throw it back to you, and that will be it. Thanks, everybody.
Hi everyone, I want to thank you for coming out to Online Trader Central tonight. Kind thanks goes to our host, Mike at Orderflows.com. I've been posting all the information, how you get the free ebook, how you get hold of him after we're done, And we really appreciate your time and attention here today. We know that time is one of those commodities that are just not trading on the internet, and you can never get.